there are a couple of things going on, right? It's as you lose video, video is a much lower margin product than broadband, and so you just get a positive mix shift that raises margins. I think everybody sort of understands that and gets that. So as video declines, there's some uplift for margins from that. But beyond that, there are a number of other things that happen. First is because customers get a discount on broadband by taking video, when they disconnect video, their broadband price goes up, and that gooses margins even more. You also have the fact that video is a more cost-intensive product for non-programming costs, so things like customer service and repair and maintenance. So as video declines, you get some elevation in margins from that. So what we've already seen now is margins going much higher already than anyone expected, and the idea that 40% is the baseline for cable margins, where it's been for so many years, is just not appropriate anymore. I think it's absolutely reasonable to think that you could see 50% margins for most of these businesses as they start to look more like telecoms and less like media companies.
Now, you say as well, and you and I have discussed that the cable operators, as they increasingly make peace with the idea that at least some measure of cord cutting is acceptable and maybe even desirable, they stop throwing traditional save offers, as you said, at customers threatening to leave. But, Craig, it is still a profitable business, isn't it? I mean, do I really want to see it start to really erode? Even though they may not make that much money, and the margins obviously are far less than they are in broadband, they still make some money.
Yeah, no, you're right, David. Nobody here is saying we're going to abandon video. I mean, there's some small cable operators that have done that, but none of the majors are remotely thinking about abandoning video. What they're talking about abandoning is these crazy save offers where if you call and threaten to leave, they'll give you $60 a video for $40. I think they've come to realize that's not a sensible response anymore. And so now when you say, I'm threatening to leave, they will say, well, let me help you choose between YouTube TV and Hulu and make sure at least you get the best price. Because what they're trying to do is say, we make our money from the broadband relationship, and the idea that we're going to try to keep customers in a video service that they don't really want is not good customer service, and ultimately it's not going to be profitable for us to do. But remember, there's a huge segment of the market that still wants a video product, and the cable operators do make money from those customers, and they're not talking about abandoning those customers at all.
No, although it's interesting, given the focus we do have on cord cutting and obviously the rise of the various streaming services, this new attitude, if you're correct, would seem to accelerate what will be that continued trend of cord cutting. Do you agree?
Yeah, no question about it. No question about it. You know, it's funny. You can look at that comparison. The satellite operators are losing video subscribers at 10% a year between the two, DirecTV and Dish. The small cable operators were losing cable subs in the 8% range. And Comcast and Charter, who are really the center of gravity of the cable industry, are losing subs only in about the 2% range. The reason they're not losing cable subscribers nearly as quickly as the small cable operators isn't because they're having a harder time hanging on to them. It's that the small cable operators decided not to try. All we're saying is I think you're going to see the large cable operators say we're not going to try to save those marginal customers either, and if you let them go, you're going to see rapidly rising margins. And the other argument we were making in this morning's note for our subscribers is not only does that mean estimates have to come up for margins, but it also means warranted multiples have to come up quite a bit, because you are much more efficient at converting EBITDA into free cash flow as margins come up and capital intensity stays roughly the same or even comes down.